Welcome. In this clip, we discuss money and the money supply in the economy. In the modern economy, money is an item or a verifiable record that fulfills three functions in the economy. These three functions are the following. First, money serves as a medium of exchange. This means that money is generally accepted by economic agents and also by the government as payment for goods and services or as a mean to pay your taxes. Without such a medium of exchange, we could only do some trading by barter, and that would be very difficult and very costly to do. The second one is the unit of account. Money can be used to measure and compare the value and cost of goods and services. For example, within the Economic and Monetary Union of the European Union, the euro is the unit of account. As a result, all prices, costs, taxes are expressed in terms of euro. And finally, money can also be used as a store of value. That is, the purchasing power that someone has in one period could be stored, preserved, and transferred for future periods. It is important to see that in a modern economy there is a very wide range of financial and monetary assets, and these cannot always be called money. So let us look at the list of such assets. First, the currency. Now, currency means all the coins and banknotes in circulation, and you can use these to purchase goods and services directly. The next one is demand deposits, which are balances in bank accounts and which can be accessed very quickly. You can use, for example, your debit card to do payments from these demand deposits. The next one is saving deposits. Now, these are interest-bearing deposits, and as a result, you cannot just freely remove them and transform them into demand deposits as quickly as you would like to. It may be the case that you have to wait a certain period before using saving deposits to fill up your demand deposits, or maybe if you do that too early, then you have to pay a fee. Also, an important financial asset is the debt securities. Now, this is basically that you lend a certain amount of money to a government or a corporation, and in exchange you will get a corporate or government bond or perhaps a treasury bill. These must first be sold again so that you could use them as a medium of exchange. So directly debt securities are not used for payment generally in the economy. You have to transform it into a demand deposit or a currency. And finally, equity securities, which are just simply those instruments, those assets which signify ownership in, for example, a company, and we refer to these usually as stocks. Now, these should also be traded and sold in order to convert them into some currency or demand deposit form. So if you look at this list, then you will see that this is a list decreasing in terms of liquidity. And liquidity will mean the ease of using these assets for purchases and buying goods and services. That is, liquidity is going to show you that how much these assets can be really considered as money. Now, usually we focus only on the first two. That is, we will say in this, during the course and these clips, we are going to use as money, we are going to use the currency and the demand deposits only, because these could be used for payments immediately, and all other financial monetary assets will not be treated as money. Of course, in practice, it is possible that you also include saving deposits it is also possible to do that, and there are so-called monetary aggregates which do that, and their currency and demand deposits would be the M1, and if you add saving deposits, then you would get M2. So this is possible to do in a different way, but for the model of money supply, we will very soon look at, will operate with the idea that money equals currency plus demand deposits. To understand how money is created in a modern economy, first it is necessary to look at the modern bank system. In modern economies, we have a two-tier bank system. At the first tier, the upper level, we have a central bank which has monopoly to issue currency, and also it serves as the bank of all other banks which are in the second tier. So it will lend money to these banks and also hold account for those banks. The central bank is also responsible for the monetary policy and also for the management of government debts. So it will be the central bank which is going to act also as some kind of treasury for the government and will issue government bonds. The second tier has the commercial banks or other financial institutions that can collect savings and lend these assets to firms and households. These institutions can also participate in the creation of money, but this will be a different money than what the central bank can create. This money, namely, will never be present in a physical form, but it will only exist as temporary entries in different accounts with different banks. This type of money is called the bank money. As I mentioned earlier, commercial banks need to have accounts with the central bank, and this is going to be one way how the central banks can limit and affect the ability of commercial banks to create money. One way to keep track of the activities of a bank is to look at its T account. The T account is widely used in the double entry bookkeeping. Now, why it can be quite complex, for this course we are going to just use a single, very simple description of the bank's accounts. So there are here basically two columns, assets and liabilities. Assets are those assets which are owed to the bank by other agents, while liabilities are those assets which the bank owes to other agents. So if you look at the different categories, you will see that within assets we have, for example, currency. So, of course, if the commercial bank has a certain amount of currency, which you can also refer to as vault money, that is going to be a demand towards the issuer of currency, that is the central bank. So, the currency can also be seen as some kind of debt of the central bank towards an agent, and in this sense, the bank is just an agent. Also, the banks are required to hold accounts with the central bank. So they will be present at the first tier as depositors, and as a result, they can withdraw those deposits. They have a claim on those deposits. Also, if the bank lends money to someone else, then that person will owe to the bank, and that means that all the loans provided by the bank are part of the assets. Similarly, if the bank holds stocks, bonds, or other securities issued by other agents, that's also a claim, so that is part of the assets. And if a bank holds a certain stock of foreign currency or gold as a possible reserve, then that will also be added to the assets. The liabilities there are, on the other hand, than those assets which the bank owes to someone else. So the bank will collect deposits. And the owners of the deposits, the depositors, will have a claim on the money they deposited with the bank. So the bank owes them the amount they deposited. This is also true if the bank decides to take a loan from, for example, other banks. And finally, the liabilities also include the capital, the starting capital of the bank, because after all, the bank is also an enterprise and it starts with an initial investment. So there will be stockholders and owners of a bank, and of course the bank owes them their contribution. Now we look at one version of the bank system, which is referred to as the full reserve system. Now, what is a bank reserve? The bank reserve is that amount which the bank received but did not loan out. A full reserve system means that whatever the bank receives cannot be loaned out, but it must be held as reserves. So the reserves will always equal the deposits. So in this scenario, someone deposits 100 euros in the bank, but because the bank needs to keep this 100 euros as reserves, there is no room for lending money to anyone. So as a result, we started with 100 euro money and we ended with 100 euro money. The full reserve system simply is not capable of increasing or reducing the amount of money in the economy, so it wouldn't work in a modern economy where the demand for money is fluctuating depending on the economic conditions. In a modern bank system, commercial banks can create money because there is a fractional reserve system in place. This does not require the banks to keep all what they receive as reserves, but only a certain portion of it. In this system, we will assume that there is a regulation, a reserve requirement of 20%, so the bank needs to keep 20% of its liabilities as reserve, and the rest can be used to provide loans to other economic agents. The first step here, again, is that someone deposits 100 euro worth of cash in the bank. That means that the bank's liabilities will increase by 100 euros, but because the depositor paid with base money, that also means that the currencies will increase within the bank by 100 euros, so the reserve will also go up by 100. How much of this reserve must be maintained? Well, according to the regulations, only 20 euros, and the rest, 80 euros, can be loaned out. If there is someone who actually wants to borrow money. If this is the case, then the change in the system will only affect the assets. So simply, instead of having 100 in reserve, we have now only 20 in reserve, and the new loan will appear in the assets as with the value of 80 euros. If you add up the assets and liabilities, it is still 100 euros, so no money was created in the economy. Money is really created if the loan provided is deposited within the bank system. So what happens if the new loan is immediately deposited with the same bank? You can see that the new deposit will appear both in the assets and the liabilities. So there will be a new deposit of worth 80 euros, and that new inflow of deposits will automatically fill up the reserves again to 100. But if you add up assets and liabilities, now you have 180. That means that this 80 euros became a new extra amount of money in the banking system. This is our bank money, so it does not take the form of banknotes, but it is money. It is used to buy services and goods. If you look at the situation, then you can see that with the new liabilities 180, using the rule that 20% must be kept as reserve, we know that the new reserve must be at 36. So that means that what remains above the 36 in the reserves, which is 64 euros, can again be loaned out. If you do this, then in the next step, you will see that once this new 64 euro worth of loan is deposited in the same bank or within the same bank system, then the total assets and liabilities will increase to 244. So now we increased the total money supply by 144. And the multiplication will continue as long as there is someone who would like to take a new loan. Now, if you assume that whatever loan you offer, there will always be someone who wants to take that loan. And also, if you assume that all the loans will be deposited bank into banks, that is, people will just not hold any currency, and this is very unlikely to be the case, but if you make these simplifying assumptions, then you can immediately see that the multiplier is going to be 1 over the reserve ratio, which is 0.2, that is 20%. So altogether, if you deposit 100 euro in the system, then finally the system will create an additional 400 euros. And so altogether, the bank system will have 500 euros. The money multiplier is nothing else than the amount of money that the system can create from a single unit of base money. It is very important to understand that this system does not mean that the banks can make as much money as they want, because you can see that there are very strong limitations on the ability of the bank system to create money. The first one is that it is not always possible to make new loans, because in worse economic situation, the firms may be less likely to take new loans. That means that there could be a point when this multiplication process will just simply stop without ever reaching its full capacity. Also, it is possible that firms actually start to repay their debts. And as more loans finally led to more money in the economy, less loans, that is the repayment of debts, is going to reduce the amount of money in the economy. So another important limitation is that the public may not want to keep all their money in the form of deposits. People will still keep some of their money in the form of cash or currency. Now, there can be periods when people lose their faith in the financial system and they will start to hoard money. So very quickly, the money multiplication system can be stopped by simply agents not being willing to put their money into the banks. So at an early point of this process, it is also possible that even if the bank loans some money to a firm, it will never appear again in the bank system as a deposit. And this is also a limitation on the ability of the banks to create money. So fractional reserve system has a big advantage, that it will be able to flexibly provide the necessary amount of money to the economy according to the economy's needs. So when less money is required, then the bank system will provide less money, and when more money is required, then the bank system will be able to provide more money. But the working of the bank system depends very strongly on the trust of the population in the financial system and also general governance by the central bank, which we refer to as monetary policy. In the previous slide, I mentioned that the money multiplier in that simple form, that is being equal to 1 over the reserve requirement, can only be true under very special circumstances, namely that agents want to keep zero currency and all the income and revenue they get will go immediately to the deposits with the banks. But this is a too bold assumption to make. So we should then arrive at a more reliable, more general version of the money multiplier, and this is what we are going to do now. So first of all, we denote money by M. And as we saw earlier, money equals the sum of demand deposits, denoted here by D, and all the currency, which is denoted by C. Another concept is the monetary base. This is denoted by B. This includes the reserves of the banks and all the currency in the economy. The money multiplier is nothing else than the ratio of money to monetary base. Now, if you use this, then you get this particular expression, which you can see on the screen. In order to see better how the behavior of different economic agents may affect the bank system's ability to create money, we can divide both the numerator and the denominator of the above expression by D. And this is going to give us then an interesting alternative version of the money multiplier. So C over D can also be called the currency ratio, which is just simply the ratio of currency to deposits. In the previous example, we assumed that agents do not want to hold any currency. So in that case, C would be 0 and D would be equal to M. That means that we would then go back to the simple version that the lowercase m money multiplied equals 1 over the reserve ratio. The reserves over deposit is called the reserve ratio. Now, if people believe that in the future there could be problems in the economy and there could be problems in the monetary system, then they may decide to increase their holdings of currency and reduce their holdings of demand deposits. So, in times of crisis, it may happen that the currency ratio starts to rise. And this would reduce the money multiplier.